You can see here on the NASDAQ, we've got, I guess it's a Broadway musical actress here, Joy, who is playing the role of a woman who invented like a mop and apparently some hangers. And I think Jennifer Lawrence did the film version of that. Stocks to watch. Katie, what have you got today?
I think it was a self-wringing mop, if that adds
a self-wringing mop.
Yeah.
That's awesome.
I guess, yeah, that's useful. Anyway, let's talk about sneakers, because Deckers climbing after Ugg and Hoka sales jumped last quarter. Shares recovering after falling nearly 50% this year, currently higher by about 17% as trading kicks off. A really interesting read on consumer demand and also on the state of supply chains. We'll be talking about Deckers a little bit more later this hour, Matt.
All right, Intel is down because of concerns that its new CEO is more focused on cost-cutting than restoring the chip maker's technological edge. It's really basically got no plan for a comeback, and investors, I guess, waking up and just realizing that this morning.
Well, it had been building a pretty impressive year-to-date rally, and then Lip-Bu Tan took the mic yesterday and kind of didn't give much of a reason for hope for shareholders there, basically really hammering home that they're cutting costs, okay? They're not focused on getting their edge back, so not quite inspiring for shares.
No, and it's worth less than $100 billion now, which is, well, with NVIDIA at $4 trillion, it's slightly disconcerting. We're back with Alpine Saxon Woods Chief Market Strategist Sarah Hunt. And Sarah, you were talking about the tech stocks. Obviously, you pointed out Intel and some others have specific issues. But in terms of the big ones and this AI push, we're seeing more and more money thrown at it. Google just a couple of days ago upping its capex to $85 billion for the year. Can you still be bullish on this sector?
Well, I think that the upping in capex is telling you that that spend continues, and that spend is hopefully there in search of growth. If that is all going to work in the way that they're trying to get it to, then yes. And I think that this is what the market needs right now, because to be fair, where valuations are, if you don't see some of the areas that are growing grow well and grow profitably, then I think that you have some issues with the general level valuation. So yes, I think you can continue to keep that story, but it is definitely one that needs to keep going.
Absolutely, and if you follow the money here and think about where the likes of Google are spending that money, spending that capex, it broadly leads you in a substantial way to other tech companies. So is that where you would want to be right now, where companies are spending money on other companies?
I think that there's an absolute line from one to the other. There's also an enormous amount of ancillary work that needs to go into that. You have a lot of power gen that needs to come online. You have a lot of industrials that need to support all of this, because if you just have the chips, you don't really have enough. You need an enormous amount of data centers. You need an enormous amount of other things that come into all of this. So it's the spend technology on technology and the spend on infrastructure and other industrials around that technology stack.
What else do you like here besides technology? I mean, if you get away from that, are you bullish industrials?
There are some interesting individual stocks that we like a lot. There are some interesting places in industrials. I think, I mean, even on ancillary stuff on the energy side, you have pipelines, you have something like Williams, but something like individual circumstances like a James Hardie that just made a purchase of a U.S. company, AZEK, that does building supplies and the things that go outside of buildings and decking. There are individual places where there's some really interesting things going on, and I think that that's looking for places like that and looking for where the market is misunderstanding something is a great place right now.
Sounds like you really need to do your homework there.
You really do, and I think that this is back to the whole stock pickers market. If you're not just jumping on the technology bandwagon only, when you're looking at other stocks, you need to be quite careful, because as you can see from some of the earnings that are coming in, there are some very idiosyncratic earnings stories out there, either good or bad, and when they're bad, the market is very punishing to them right now.
When you say stock pickers market, it makes me think of ETFs. You know why?
That. Because you've been hanging out with me for...
That's because I've been around Katie for too long. No, I mean, it's so weird, and I don't know if it matters to you, but that people don't just buy stocks themselves anymore. Now they buy tokens that represent stocks, or ETFs that are single stock ETFs.
Yeah.
What do you think about that whole phenomenon? Does it matter?
Well, to the extent that something like a single stock ETF is just there to juice it one way or the other, like triple up or triple down or something, then there's a whole bunch of leverage in there. That's something that people like to play with. It's sort of like playing with options, right? But it's doing it in a different way. And I think that there has been a lot of individual stock on the retail side buying, and that's one of the things that I think that a couple of the strategists were calling coming out as problematic, is that how much of that is going
Right.
on, because that sort of tells you it's a little bit end gamey or late stagey. But I think that, I mean, just to go back to some of the fundamentals on actual stock picking, which is a fun thing to do if that's what you came into this business to do, is something that right now can be very impactful.
Yeah, I'm glad you mentioned the bigger retail presence. That was definitely one of the pillars of Michael Hartnett's notes. I do want to just quickly go back to earnings season because we got some really interesting drama around Centene this morning. Centene is an insurer.
Household name.
Household name, at least in my household. Anyway, so I thought it was interesting that you saw shares fall double digits pre-market. Remember, they pulled their guidance earlier this month, and that was received very poorly by the market. They reinstated guidance almost $6 lower than their previous forecast, but still you're seeing shares rally right now, and it seems like the message there is that even bad guidance in this environment is being received better than no guidance at all.
Well, for something like Centene on the insurer side, the changes in regulations on what's going on in the healthcare space is very difficult because you had these models that people had extrapolated into forever, and now they're having to redo them. So that's a very specific problem that has been sort of a concern of ours on the healthcare front, because when the government decides to take a shining light and say what's going on in this corner of the healthcare market, very often things can go pear-shaped if you had a plan in terms of earnings.
It almost seems binary. That's like an on-off switch, right?
That's a very difficult one. It's why healthcare is such a difficult sector right now, because you know that people are looking at taking costs down in healthcare, and you know that in some cases someone is going to be a beneficiary of that and someone is not. And quite clearly that was not. So I think it was better that they put some guidance out, and it was like, well, at least it's not zero. But compared to where it was, that was a big fall, because I think that stock was, somewhere in the high double digits, 80s, 6 months ago, 100. I mean, that's a huge fall down. So I think
it's down 55% year to date.
Yeah, I think that there's that's where you have some real risk in there as things change, and when you get new people looking at new ways to save money in the healthcare space, you have to be careful about who's going to be the non-beneficiary of that.
All right, Sarah, it's always awesome to have you here. Thanks so much for joining us. Alpine Saxon Woods Chief Market Strategist Sarah Hunt. Let's get a quick check on the stock market right now. Just 7 minutes into the session.
Yes.
But Katie, you're going to do this.
I'm going to walk. I'm going to talk.
Go on over there and show us what's happening.
I want to tell you about the breadth right now, Matt Miller, because it's pretty good. You wouldn't necessarily know that by looking at this pretty uninspired move at the index level, but you have more than 300 names in the green right now. And you take a look at what's leading. Tesla, for example, seeing some signs of life here. You have Palantir, Eli Lilly, United Health, really punching this market higher, or trying to, but look at what they're stacked up against. NVIDIA actually is your biggest contributor to the downside on a points basis right now, just a decline of about 0.4%, but that's painful when we're talking about NVIDIA. Then you take a look at Intel. Intel having a worse day when it comes to percent. That is in second place in terms of biggest losers on points. Amazon, Alphabet. So big tech feeling the pinch here, and you're going to see that on the sector level as well. That good breadth that we're talking about, it holds. When you take a look at the sectors, you have more green bars than red bars, materials and healthcare at the top. The problem is those aren't very big names. You take a look at the weights here. You have tech, a small move overall, but still in the red. Real estate, communication services down about 0.4% right now, Matt Miller.
All right, so some individual movers that are pushing their weight around. I note NVIDIA is now worth it's down today, but still worth $4.2 trillion. Coming up, we're going to talk about Deckers, which does not make decking. It makes Uggs, it makes Hokas, and the shareholders are getting a much-needed reprieve after a strong earnings report. Details next. This is Open Interest.
Well, I don't know about the meeting. I know it's taking place, and he's a fantastic man. He's a great attorney, and people should really focus on how well the country's doing, or they should focus on the fact that Barack Hussein Obama led a coup, or they should focus on the fact that Larry Summers from Harvard, that Bill Clinton, who you know very well, and lots of other friends, really close friends of Jeffrey Summers, should be spoken about. Because, you know, Jeffrey Epstein should be spoken about. And they should speak about them, because they don't talk about them, they talk about me. I have nothing to do with the guy.
Are you considering Are you considering before you do any business deals with the UK?
Yeah, I'm going to meet with the Prime Minister right now. We're going to be over there in about 6 hours. We're meeting with the Prime Minister tonight. We're going to be talking about the trade deal that we made and maybe even improve it.
Are you considering climate change for Ghislaine Maxwell? Are you considering climate change for Ghislaine Maxwell, sir?
I saw homeless people sleeping right outside the gates of the White House. Are you concerned about that?
I think it's terrible, and we'll have them removed immediately. We do remove it. We've got to get the mayor to run this city properly. This city has to be run. You know, I have the right to take it over, and I think it's terrible. Where are they? Where did you see them?
Just right outside on Pennsylvania Avenue.
Near the Treasury.
Right across this Mafia Park near the Treasury. Have you heard about Todd Blanchard's interview with Ghislaine Maxwell?
Are you still disappointed in President
Arden or Clemens?
Well, I don't want to talk about that. What I do want to say is that Todd is a great attorney, but you ought to be speaking about Larry Summers. You ought to be speaking about some of his friends that are hedge fund guys. They're all over the place. You ought to be speaking about Bill Clinton, who went to the island 28 times. I never went to the island.
Do you maintain you did not write a letter for Jeffrey Epstein's birthday?
I don't even know what they're talking about. Now, somebody could have written a letter and used my name, but that's happened a lot. All you have to do is take a look at the dossier, the fake dossier. Everything's fake with that administration. Everything's fake with the Democrats. Take a look at what they just found about the dossier. Everything is fake. They're a bunch of sick people. Where did you see the people laying outside? Exactly?
Right across the street from Lafayette Park, sir. Towards 15.
We'll take care of it.
Are you hoping to meet with President Putin for bringing hostages home? What are the alternative methods to bring hostages home?
Well, we got a lot of them out, and it's I've always said those last 10 or 20 are going to be the toughest, because Hamas knows what happens when they don't have any bargaining chips. And they really broke a deal. They broke a deal, and you're going to have to do what you have to do right now. It's a terrible...
That's President Trump, obviously speaking at the White House as he gets ready to head off to Scotland. We want to turn here back to the stock market, 15 minutes into the session, and talk about a couple of products, Uggs and Hoka shoes. They're saving holding company Deckers from a dismal year for shareholders. Sales for those brands surged in the second quarter despite fears around tariffs and consumer sentiment. Bloomberg's managing editor for global business joins us now here on the desk. Shelley Banjo, great to have you with us.
Great to be here.
Let's talk about, these two brands make up a shockingly large portion of Deckers outdoor revenue.
Yeah, now they're at 95%. So this company might as well be renamed Ugg and Hoka at this point. And there's a standout among the whole entire consumer industry right now, landscape, because these are things people actually want to buy and continue to be buying them.
They could call it Hug,
that's what I said.
Just smush the names together there. You said something really surprising in the commercial break, that you take a look at this breakdown of Ugg sales. It's actually men that are a really fast-growing segment within that brand.
Yeah, I was shocked during the earnings call. One of the executives said that men's sales of Ugg in particular are growing at almost twice the rate of the rest of the business, which is sort of crazy when you come to think of it, but it sort of goes to explain the reason of why are Uggs still growing? Haven't we penetrated the market? Doesn't every woman who's going to buy an Ugg have an Ugg at this point? But it turns out there's a whole, selection of other people in the world who are buying these Uggs.
It is the total addressable market.
Exactly.
For me, it's very weird because I find it strange that men wear
I don't think I've ever seen that.
tennis shoes in day-to-day life anyway. When they're not playing tennis, it doesn't make sense to me.
Matt only wears dress
only
shoes.
suits.
I'm an
Only
anachronistic
suits.
outlier. In terms of Hokas, what's the growth look like there? Because it's such a crowded sector. You've got On Cloud shoes. Obviously, Nike, Adidas, Puma had pretty bad numbers today, but there's a ton to choose from.
Yeah, I mean, the interesting moment that Hoka's having right now is that they created this whole sort of clunky, chunky shoe. And so as now that's becoming the thing to do, everyone's copied them, Nike, Asics, you know, everyone. People are like, oh, if I want a chunky shoe, Hoka is the first thing that comes to mind because they created the market to begin with. And so they have their own stores, they have an opportunity to grow their own stores, and people are still buying them.
I bought my first pair of Hokas in 2015. I have never looked back. In 2015, those minimalist shoes were still really popular, but...
Barefoot running.
Yeah, I never got into that. But when it comes to Hoka...
By the way, Katie buys a new pair of running shoes from Hoka every 6 months or 500 miles. That's her rule.
Yeah, that's you know, the way to save your feet.
Well, that's the thing. I buy the Clifton model. I love my Cliftons, but they recently raised prices. They're pulling different levers there.
Definitely, and they talked about that in the earnings call. They said that they are selectively raising prices to offset the tariffs. They talked about raising prices as much as $5 a pair on certain shoes, but not across the board price raising, and also looking at areas where they could raise prices more. So, for example, they brought up kids as an area where they might be able to raise prices.
This actually is fine for me because my dad and I share a Roadrunners sports account, so I think it's on his credit card.
So your dad is still paying for your shoe habits?
Yes.
That makes sense. What about consolidation in this industry? I mean, like we've said, there's so many different players. This stock hasn't done well. Today, obviously, is a little bit of a turnaround, but is there any possibility that we see some M&A?
Yeah, I think so. I mean, we saw the Skechers deal not too long ago. You know, Deckers is a company that has bought brands. You know, they bought Hoka before. So you're looking around as companies merge and they look to spin off certain brands. Could Deckers be a acquirer in this case? It's a good question.
I should say, it hasn't done well this year, right? Year to date, because if you look over the past 5 years, it's actually up Deckers Outdoor Corp 250%.
Not bad.
All the consumer brands are getting hit with the tariffs. People are saying, oh, tariffs equals consumer weakness. So.
All right, Shelley, great having you on set with us. Thanks for joining us. Bloomberg's Shelley Banjo. Let's get a quick check on what's going on in the market. The broader indexes right now, you can see, are rising. The S&P 500, 63.74. The NASDAQ right now just barely up, about 1/10%. Yields are inching up as well. You can see the U.S. 2-year yield coming up, but the 10-year yield is moving up a little bit more severely, over 440, 442. Is the level right now. NVIDIA, you can see down, it's only 0.2%, but as Katie pointed out, it's the biggest contributor to losses on the S&P because it's such a huge company, $4.2 trillion. Intel off 9% as investors seem surprised that the new CEO, Lip-Bu-Tan, doesn't have a plan for growth there. Here's a couple of the shoemakers. We were just talking about Deckers, but On Holding also rising, maybe in sympathy with them. And then Paramount Global up 2% after the deal goes through, and also after paying $1.5 billion to get South Park on for the next 5 years. And then Centene. I mean, we all know the insurance company Centene, ticker CNC, rising 2.8% after coming out of the forecast for earnings, Katie, of $175, even though it previously had forecast earnings of $725. But it's better than nothing.
Bad guidance is better than no guidance there. Also, when it comes to Intel, I think Lip-Bu-Tan would tell you he does have a plan. It's just that shareholders seem to really not like it.
Yeah, but it's more about cutting costs, really, than returning to amazing growth, right? They're not going to be the next NVIDIA anytime soon. And they're pulling back from so many investments, like the all-important investment that they had planned at one point, $30 billion investment in the great state of Ohio.
I know you took that personally. We're going to continue to follow the Intel story, but let's talk about ETFs, because it's becoming a stock picker's market again. But this time, it's not about active managers. It's through ETFs. Bloomberg Intelligence ETF Athanasios Saravegas took a look at this trend, and he joins us now. And I was reading your note, and this line stuck out to me, that single stock ETFs are seeing far more activity than ETFs managed by stock picking professionals. So it sounds like investors, rather than outsourcing portfolio management, are just taking it into their own hands.
Yeah, I think that's exactly right. They're cutting out the manager. And I think I'll give you a perfect example, ARK, right, which was like the epitome of stock picking a couple years. They're actually having a fantastic year, but they have outflows in their funds. And what's happened is with this emergence of now single stock funds, if you look at Kathy Wood's top 10 holdings, there are leveraged single stock ETFs tied to every single one of those. So I think investors are like, well, I could do that too, and I could have levered exposure to these stocks. So it seems that they're now just skipping over that and just going straight to the stock picking themselves.
So where does this leave the industry? When you think about how this is going to develop, there was a filing, I think it was from RecShares earlier this week on the 22nd, and I think there were more than 30 listings in there for single stock ETFs. Are we just going to have thousands and thousands of these single stock funds?
Yeah, we better like settle in because it's going to be a lot of fun. Like every possible stock you can think of, I think, is going to like have some single stock ETF. And then there's bulls and bears, right? So there could be two tied to every single one. There's different leverage factors they can use. There's multiple issuers that can do it. So it's just going to be a flood of single stock products coming into the market. And there's a tension, right? Like you already have a 2x Robinhood launched this year, already has a couple $100 million in assets. Like this is really intriguing to the issuers. So I don't see any reason why they wouldn't want to continue just bringing these types of products out.
And Matt, I saw an interesting tweet from Ben Johnson from Morningstar yesterday that there are now more U.S. listed ETFs than there are actually U.S. stocks. So
wow.
Really crystallizes this point.
That is really shocking.
Yeah.
I'm actually blown away by that figure. More ETFs than single stocks in the U.S. That's crazy.
I wonder how Athanasios feels about it.
Well, and I also wonder, Athanasios, about tokenization. I mean, you and Eric at BI will, I imagine, cover both tokenization and ETFs. Like, what's the difference between a single stock ETF and a token that represents a single stock?
Yeah, we debate this quite a bit on the team. I'm not as bullish on it because I think, to your point, I don't see the major difference there. I don't think that the marginal benefits that you're getting from it are that strong. But I think tokenization can open up some really other interesting areas like private equity, maybe some really hard to reach emerging markets, things like that. But I think trying to just replace a highly traded U.S. stock with a token, I think you just get it too easily with ETFs. Most of the platforms are doing 24-hour trading now anyways, which is one of the benefits that they tout. So I don't think that that's where the money's going to come from. I think it'll come from other more, opaque asset classes.
Well, I'm sure that is a vibrant and lively debate that you're having on the desk over at Bloomberg Intelligence. That is Athanasios Sarafakis of BI. Have a great weekend when you get there. And make sure to tune in to ETF IQ on Mondays at 12 p.m. New York time. And you can read all about the ETF industry in my weekly newsletter. That is Bloomberg.com/ETF IQ newsletter. Please sign up.
On that show with Eric Balchunas.
Yes.
And I wonder, and Scarlet Fu, but on the BI desk, is that like Athanasios, Balchunas, and James Safer? Do they all three of those guys just sit there tossing the football around debating tokenization versus ETFs and whatnot?
I think so, and honestly, it sounds pretty fun. I'd like to get invited into their IB chats.
It does. You're not in their IB chat?
We have other chats. We are news. There's a firewall there.
All right, well, it's been a pretty fun Friday.
It has been.
Hasn't it?
Yeah.
All right, you have a fantastic weekend.
Okay.
We're looking at markets that continue to rally higher, well, slightly higher, but at all-time highs. In the next hour, Ann Milletti is going to join us. She tells us where she sees a sweet spot in the market right now, so maybe there's room to run. And we're going to talk about prediction markets with the CEO of Kalshi as well. We are 30 minutes into the trading day looking at all new record highs.
It's not getting boring for you?
It is kind of, but it's, I mean, for the men and women of America who hold stocks in their 401ks, it's a good thing.
Unless you think it's a bubble. Anyways, you're looking at an S&P 500 up almost 0.2%. The NASDAQ 100 also flying high into the weekend, Matt.
Yeah, absolutely. Coming up, President Trump says he won't fire Fed Chair Jay Powell over cost overruns at the Fed, but he does continue to want lower rates.
And meanwhile, we're going to talk to Kalshi because Elon Musk's AI startup teams are going with the prediction markets firm to bring Grok to those markets. We're going to hear from the CEO, Tarek Mansour, later this hour.
And speaking of AI, meet the CEO behind Reflexivity. The platform itself is fascinating. It tries to help investors make more money, but it's also backed by a guy who got the fastest PhD at Harvard history, studied under Ken Rogoff, and worked with Stan Druckenmiller.
Pretty good pedigree over there.
You mentioned the risk of a bubble rising alongside stocks. Bank of America's Michael Hartnett is worried about that as well. His team warned of frothiness in late 2024, now says looser monetary policy and easing regulation could spell trouble for stockholders as it invites more retail investing and risk-taking. Hartnett says, quote, bigger retail, bigger liquidity, bigger volatility, bigger bubble. Joining us to talk a little bit about that, give us her take, is Ann Maletti, Allspring's head of equity investments. And I mean, as long as it doesn't burst, a bubble doesn't really bother me that much at all. Are you worried?
Look, there's parts of the market that do feel a little extended, but there are parts a little bit more underneath in areas that people are not paying attention to, where I still think there's opportunity. And that's what we're paying more attention to. At this point in any cycle where you've had such strong returns, it's all about risk versus reward and really trying to find out where there's still reward while not taking on quite as much risk.
And at this point, do you take some profits, given how far we've come, and where would you take them if you are?
Look, I do think, when you look at some of the more concentrated names in the benchmark where you definitely have had good growth, good cash flow growth, there are high expectations. And we're kind of starting to see that come through in earnings season. If companies can produce and continue to grow at the rate the market thinks they can, that multiple will likely at least stay steady and the earnings, can continue to take the stock up. But if there's any disappointment, not only can earnings go down, but the multiple can also come down substantially. And so I would be more cautious about some of those larger names with a lot of concentration.
And those, the big cap stocks, for the most part, aren't too worried about tariffs. Maybe it affects Amazon slightly, but it doesn't really look so bad. I wonder, though, as more and more companies like General Motors, for example, eat up some of these tariffs in order not to pass on too much inflation to the U.S. economy, do you see that hitting earnings, on the broader index down the road?
Yeah, Matt, it's a great point, and it's kind of the unknown. We just don't know the full impact yet. Up front with the tariffs, we knew we had a lot of buildup of inventory coming in, so we wouldn't feel the impact right away. We also know that companies do adjust, and they are finding ways to either eat some of this, pass on some of it. We're hearing companies talk about that even now as they're reporting earnings about how they're trying to approach it. But because we don't know what the full impact is, the range of outcomes is broad. I do absolutely believe profitability and rising margins will be harder with companies that suffer from those higher tariffs.
And what does this mean in terms of the risk skew for the rest of the earnings season? Is the market still skewed to the upside in terms of risk for investors, or is it more skewed to the downside at this point?
Sonali, it's a great question, and I've been paying a little bit of attention to that too, and asking myself a similar question. One of the things that I looked at is if you look at the S&P 500 and the stocks that have outperformed or are hitting new highs, because again, there's so much focus on what is working. We're almost at 70% of the S&P that is hitting new 200-day highs, or getting to that 200-day high. And so that is historically a pretty healthy sign that there's more to go. That broadening out of returns is actually a healthy thing. And so while we continue to talk about a select few names, investors are paying attention to other places.
There was a time, Ann, when I would lean over Sonali's shoulder and check what's going on in the bond market every day because I was worried that higher yields would spook stock investors. We're not there anymore, right? 440 on the 10-year seems pretty tame. Is that a concern for you at all? Because, the sort of Chicken Littles of the world were just so freaked out about one big, beautiful bill, and it doesn't seem to be bringing the sky down.
Yeah, I mean, I think we're really good about freaking out about the next the next thing we should worry about. It's kind of a natural effect of doing this job, right? What are the risks coming up? And so we're always paying attention to that. Look, I think we have a great fixed income team here at Allspring. I pay a lot of attention to the work they put out. I do think equity investors should be paying attention to the fixed income market and where yields are. Again, the trends haven't perfectly correlated to the past, but directionally, we'll start to, watch for the fixed income market to help make sure that we're fully assessing the risks. And that's what we're trying to do on a day in and day out basis.
At what point does the bond market become risky? It's funny that Matt mentions that because I was the one that was so worried, and Matt told me to calm down, and he was right. He was more right this year on that.
Well, to be fair, I always say that.
To calm down.
Yeah.
He does most mornings. But, and what level is concerning to you on the 10-year in terms of the spillover effects, whether it's to the S&P 500 or the more interest rate sensitive Russell 2000?
Yeah, I mean, I do think, when you get close to that 5% mark, it is, and we've seen that. We've seen, things get that high. And when they do, you start to question who's really right. I mean, what is the fixed income market sniffing out that the equity investors are not, and where are the risks? And so I would say that's the level, anywhere above 4.7, really between and 5. That's the level where it gets a little bit more concerning as an equity investor.
Ann, thanks so much for joining us. Allspring's Ann Maletti talking to us about this market as it continues to hit new highs. Let's get a look at some of the single stocks moving at this hour. For that, we go to Bloomberg Equities reporter Nora Melinda. Nora, what are you watching?
Matt, a few things I've got my eyes on this morning. I'm looking at shares of Intel. We're seeing shares falling this morning, and that's after Wall Street is really concerned about the CEO's ability to demonstrate a turnaround story here for the chip maker. They said that they're going to be scaling back some of their spending and actually canceling some of their projects here. So we're really seeing the street making this company take it to the chin this morning as we're here in trading right now. But I'm also looking at Paramount shares. We're seeing those shares higher, rising for double-digit gains here, and that's after a merger with Skydance Media was approved by the FCC. And of course, this is after the Trump administration had extracted concessions on its political coverage and diversity practices. But we are seeing shares of the company up about 30% year to date, so definitely seeing a rise today as well. And lastly, I've got eyes on Deckers here. We're seeing shares soaring this morning, and that's after the company reported that it's releasing high demand for its Uggs brand as well as its Hoka brand. Lots of people are running here to get the sneakers. We saw sales of Uggs rise 19% versus a year earlier, and that's also Hoka sales rising as much as 20% versus the year prior. So really seeing a gain of popularity here, Matt.
All right, Nora, thanks very much. Bloomberg's Nora Melinda there looking at a couple of the single stocks moving under the hood. Coming up, Kalshi CEO Tarek Mansour joins us to talk about prediction markets, which are increasingly fascinating for a number of reasons. Ties to Silicon Valley AI projects, as well as Wall Street institutional investors digging in. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Citigroup forced a trading desk head to delete a post critical of Israel's actions in Gaza that highlighted widespread starvation in the region. It's the latest sign of a corporate caution on divisive issues. President Trump's support for Israel has prompted companies, universities, and nonprofits to rethink their approach to conflict. Meanwhile, Cornell University is advancing its talks with the White House to reinstate hundreds of millions of dollars in research funding. According to Bloomberg sources, it's likely the next university to settle after Columbia's $200 million deal with to end its clash with the administration over allegations of anti-Semitism. Neither Cornell nor the White House would comment, though, on those talks. And Puma shares have plunged after slashing its profit forecast due to weak demand and concerns over tariffs. It expects to report a loss this year. Its new CEO has been trying to rebuild the brand and was counting on the thin-soled Speed Cat sneakers to drive sales, but there's a lot of competition, and it hasn't happened so far. Shonali?
Matt, we were talking about it a little earlier, that prediction market Kalshi is partnering with Elon Musk's xAI to bring Grok to prediction markets, according to a post by xAI. We're going to bring in Kalshi CEO Tarek Mansour to talk a little bit more about this change you're seeing in prediction markets. Tarek, good to see you again. I'm wondering what AI is going to do to prediction markets moving forward, particularly because you've seen them taken off so much since the election and then some.
Yeah, well, thanks for having me. Really excited to be here. Well, I think AI is one of the things that maybe the only thing that's growing faster than prediction markets today. So, you know, we're obviously incorporating AI in many ways. As you see, we've done two. I would say two of the leading commercials that were sort of AI-first commercials over the last few months. You may have seen one or two of them, and have seen sort of an explosion of the use of AI across marketing after this sort of first Kalshi AI commercial. So we're very excited about the use of the technology, what it could mean to marketing teams, and how it could make sort of teams more efficient across the board. And obviously, the prediction markets AI intersects could be very interesting going forward in the future.
Prediction markets have certainly been interesting for retail investors who are looking to put their money back based on where their expectations are. But I'm also hearing more and more from Wall Street as well. A little bit earlier in the year, I was talking to Boaz Weinstein, who has been using prediction markets to inform some of the ways he's thinking about putting trades on. How much are you talking to institutional investors, hedge funds, and other large investors in terms of how they're using your platform and maybe even putting much larger dollars to work?
You know, it's funny because when I tell people about the story of Kalshi, the genesis of Kalshi is I spent time at Goldman Sachs, and at the time it's 2016, that summer, and at the time most of the demand that was coming from institutional investors was actually, can we put a trade on Brexit or hedge against Brexit, or can we take a position on Trump or hedge against Trump? So it was very simple. Like, institutions like retail, they think in normal human terms, like what will happen in the future, and let me figure out how to make money off of it or trade on it. But the problem is, like, for example, we told people, like, you should short the S&P if Trump wins, and then they were right about Trump winning, but then the S&P rallied, so they lost money. So that was the idea when we really created prediction markets 6 years ago. So we started a company in 2018, and when we came up with the idea, it was basically this idea of like, well, there's a financial market for all these different things, except for the one thing that people care most about, which is questions about the future. So how about we build that financial market for them to take direct exposure to all these different questions? And our approach has always been like, the most important thing to do first is to legalize prediction markets. So Kalshi, what we did is we created the category, then we legalized it first and foremost. And there's a long history that we had with the government, through going through the process for years, and then suing the government to open the asset class wide open, which has finally enabled us to achieve the vision of being able to attract institutions and for people to take this credibly and seriously. And we're very, very excited about that. We're seeing a ton of demand going forward.
How do you pick, Tarek, the things that people can bet on? You've had contracts on, well, the Pope obviously was an important one, but recently you've had, I guess, a market in whether or not the CEO of Astronomer would resign after the Coldplay Kiss Cam incident. Like, how do you find these things and choose to put them up?
Well, the interesting thing, the way I think about it is, prediction markets are a financial market for any questions about the future, right? And if you think about it that way, you just have to figure out what are the most pressing, interesting, important questions about the future that we have today, this week, this month. And that's really kind of how we generate these questions. So, on that day, obviously, the Astronomer CEO went absolutely viral. And the number one question that people were asking on social was, is he going to stick around or is he going to get fired? And so we sprinted and we listed it, and that market was absolutely explosive. We've seen something like 50 million impressions on that market. And a lot of people made a lot of money, trading and forecasting whether he was going to get ousted. And this is important for Wall Street, right? Whether he was going to stick around or be gone, that's, going to have a huge impact on the valuation of the company. And a lot of people are positioned in that company. So it really is about what our customers want, what our users are suggesting, and what's viral and trending on any given week.
What are some of the most surprising big volume bets that you've seen, Tarek? I mean, it's such a wide range of issues, right? Tell us about the volumes of some of these things. How much were people betting on the Astronomer CEO's resignation? And what are some of the ones that have surprised you?
It's funny because, the history is sort of, we won the lawsuit in October, and then we launched the election market. So it was the first time that prediction markets were fully legalized in the US, including elections. And then, you may remember our numbers completely skyrocketed during the election month, right? So October, November, we were number one on the App Store. We had 500 million unique site visitors. We're pretty much kind of the largest website on the planet for a few hours on election night. And then people had the questions like, is this done? Is this going to kind of go away after the election? And, we're extremely proud to announce that this June, actually last month, we had more volume than election month. And so I think Kalshi did something here, which is, after we've legalized and opened the space, but then we've also taken it mainstream, where average Americans have the Kalshi app in their hand, and they're trading on things and debating with their friends. Now there's a shift in mentality and shift in behavior that we've enacted with the American people, where now every time they see a headline, they see the news, they want to take action on it. They want to get informed about a market and see what's happening, the same way they did with the election. And so we see it across the board. I mentioned the Pope, the Astronomer CEO is a very interesting market. Whether TikTok is going to get banned, that saga is not done. Sports has been an extremely fast-growing category on Kalshi. We're actually the fastest-growing thing that has happened to sport in a decade.
Tarek, at the same time, you're watching a lot of other companies get really interested in the space and other contenders able to get a little bigger. You see Polymarket, for example, the Department of Justice ending their probe, them striking a deal to buy a derivatives exchange and clearinghouse in the U.S. market, Robinhood looking at prediction contracts as well. What does this mean for you to see that much more competition? Does it make you want to bring on more investors, do acquisitions on your own, or even sell the company at some point?
Well, it's actually very simple, right? Whenever you see it, this is not new to any industry. We've had an incredible amount of success. If you look at our volumes, if you look at our revenue trajectory, if you look at our customer base and how it's grown, it's super normal for competition to basically want to follow. And we're excited about that competition. That's amazing. It's a validation of the business model. It's a validation that the market is going to be very large and it's growing. And we have, we're squarely in the lead position with a very, very strong head start because of our unwavering commitment to build it legally, build it credibly in the US. And now a lot of people sort of are, trying to replicate the setup and do the same exact things that we've done over the last few years. So we're super excited about that. And we see the marketplace growing exponentially over the next few years, and we're going to keep being in the lead position.
Tarek, what are the odds that you go public?
I bet yes.
I can't bet or trade on prediction markets because I run one, but, I like that side of the trade, is what I'll say.
All right, Tarek, great having you on the program. Please come in and sit at the desk with us next time you're in New York City. CEO of Kalshi there, Tarek Mansour. Still ahead, AI for finance. We're going to speak with the CEO of Reflexivity, which is a platform backed by Stan Druckenmiller that helps institutional investors, or aims to help them, make more money. This is Open Interest.
season is here.
The earnings are front and center. A slew of results already out.
Are tariffs going to eat into margins?
Bloomberg is first to break the numbers.
JP Morgan, Citi, Wells Fargo,
Bank of America, Goldman, Morgan Stanley.
I'm getting my spreadsheets ready.
With the smartest insights.
It's going to be a can-kicking situation.
Expectations are relatively low.
The market is looking for confirmation of that growth narrative.
Continuing coverage on Bloomberg. Context changes everything.
Let's get a check on the stock market right now with the move screen. I think it's the most dynamic way to view the S&P or any index. You can see that we continue to hover higher right now after opening at 63.70. We're holding it at that level. The gainers here include Tesla after saying it's going to start offering robo-taxis in San Francisco, Apple, and now NVIDIA has also turned slightly higher, but with a $4.2 trillion stock, that's enough to move markets. Intel continues to be decimated, almost off 9% right now, taking 1 point off the S&P. You also see Comcast, Amazon, Charter, and ServiceNow moving lower. In terms of the industry groups, you can see consumer discretionary, the big leader, and Tesla is a part of that consumer discretionary group, as are other car makers. That's why you have the gains there. I should say that Volkswagen's CEO, Oliver Blume, said today that he thinks tariffs will end up for those car makers around 15%. So that's really helped the entire group rise, and it turned European stocks around. On the downside, you have real estate, energy, and consumer staples. This, even though oil is up right now, these are basically defensive industries that are down, and I think that's a bullish sign. Shonali, we're going to take a look when we come back again at artificial intelligence.
America is the country that started the AI race. And as President of the United States, I'm here today to declare that America is going to win it. We're going to work hard. We're going to win it.
President Trump at a conference in Washington Wednesday, one of the American companies in that AI race is Reflexivity. It is an AI platform designed to help institutional investors make more money. And joining us now is Jan Szilagyi, the CEO and co-founder of Reflexivity. He has a record for the fastest ever Harvard PhD, where he studied under Ken Rogoff, and he spent the beginning of his career working for legendary investor Stanley Druckenmiller. So very cool connections there, Jan, and a fascinating company. Tell us, first of all, about the path to Reflexivity.
Yeah, so prior to co-founding Reflexivity, I spent most of my career investing in global macro strategies alongside Stan Druckenmiller, and that was really the formative experience that ultimately led to Reflexivity, because it taught me about using data, trying to really combine the macro and the micro and so on. So that was, I would say, key to why we're here today.
Well, so what was the data you were perhaps using there, and what is the data that you're using now? How much has it changed?
Yeah, great question. I think, you know, we had a lot of data at our disposal, but you only have so much bandwidth. So we would use Bloomberg terminals, we would dig into macro data, we would dig into company data and so on. The difference now is that we still look at all of that data, but we can look at it all the time across all companies, across a number of economies, and it takes seconds.
But what's the edge, right? Because you remember those stories when you would have hedge funds flying drones around Walmart parking lots to figure out what was happening, you know, similar for merger arb trades as well. Where do you need the person to have that extra edge, and how does data become something that's not commoditized for these firms that are looking for that edge?
So the interesting thing, the way we're approaching this, is that we are looking to create an experience, an AI-powered experience that is honest rather than trying to make it flawless. And what I mean by this is the AI is able to process a lot of data, but it will, like a junior analyst, sometimes get the data set that you think is not correct. And so you need to go back and really work with it to get the results you want. It still happens in under 3 minutes, back and forth. However, the point is that what it helps a human analyst with is to identify questions that they should be asking, but maybe they aren't.
I'm interested in how you actually started the business, right? I've been playing with AI for a while now, so I get that part. But you were investing, and then you started essentially a software engineering business, right? So are you a software engineer? Did you round up some of the best software engineers you know? Was it hard to get the funding? I guess with working with Stan was helpful there, but like, what was the actual TikTok of getting this started?
We got together the best people that we had on the buy side, others from other hedge funds. Obviously, it was hugely reliant also on the experience that I had working with Stanley. The other is, if you're familiar with the company called Kensho, and we had a lot of engineers who had that experience who came to us, and so there was a lot of continuity in terms of the early AI into then using AI and the current technology to build what I think is now the next generation investment data analytics platform.
So what, you had this idea, you knew the right group of people, and when did you have that moment where you said to Druck, or he said to you, like, we're gonna do this?
Go off, we'll fund you.
So I think it happened, you know, on many occasions I noticed that, for example, when I was watching how somebody like Stan invests, he would have a moment where a particular piece of evidence would just trigger an inquiry, and in his mind he was able to connect the dots between all of the different pieces of the puzzle that he was seeing, and that would create a thesis that would usually months ahead of the market. I thought, well, could you have a system that was able to do that on a large scale? Because I cannot do what he does, but maybe with the help of technology like AI, you might be able to scan this huge amount of data and highlight things that are happening before the market has noticed.
But it starts with asking that difficult question before the market. So what were the types of questions you were seeing Stan ask that got to those conclusions that you are now asking? What's an example?
I think this is what I was mentioning to you before. If you combine macro and micro, sometimes in what you would consider very micro data, I don't know, you look at what, for example, sales are at Lowe's or Home Depot, and that gives you some information about how maybe the housing market is doing. Or you're looking at some data that's coming out of the tech sector, and you think, oh, wait a second, cloud demand is really skyrocketing. That would be the trigger, and then you would do a lot more investigation. The difference now is that you can rely on AI to do the bulk of that subsequent work.
So what has the uptake looked like? I mean, you obviously have one very famous client to start, and I'm sure he has famous client friends that are going to call you as well. What's the graph look like in terms of your growth?
I mean, you won't be surprised that we've seen a tremendous pickup in demand. So while I can't discuss individual clients, we definitely have a number of hedge funds that you would have heard of on the platform, and we're seeing quite a lot of demand, and we're gradually letting people in and try.
So you have a list. You have a waiting list, basically.
We do, yeah.
So you mentioned earlier that the work a junior analyst would have been doing for you can now just be done on reflexivity, essentially. Yes. So what does this mean for future employment on Wall Street, frankly? What does it mean in terms of people hiring less young people, perhaps, because you could just do it instead?
So it's a question, obviously, that comes up again and again. I think the way I look at what we have built is really giving superpowers to people who use it, right? There's still a human in the loop, and I think it makes somebody a more effective investor. You're able to ask questions. In fact, the interesting experience we have had is that people aren't even used to be asking complex questions so quickly and so many in a short period of time.
But if you were hiring 3 analysts, maybe you might be hiring 1 now.
No question. I mean, I think that, but much like maybe some other areas, I think finance is probably one of the places where people will continue to want to always be ahead of everybody else. So there's much larger demand for processing power, for looking for new ideas and so on. So there will be impact incrementally, no question, and more so over the next 5 years. But I would say at the same time that what we're first going to see is just much more productive analysts that already are in place.
Are you limited by compute? You say you have a waiting list, right? So is it you need more data centers? And where do you get that computing power?
Actually, there are sometimes you do run into some bandwidth limits. It definitely happens. I would say that compute, as we are seeing, is expanding, as you can see also from the performance of the likes of NVIDIA and so on.
Are you renting that from, one of the big hyperscalers, or are you building your own data centers? And how does that look going forward?
Yeah, we're using third-party providers, a number of different big cloud providers. But we probably going forward, I think that is something that a lot of us are going to look at, also partly for security reasons. You have clients who will demand that.
What are you looking for in terms of valuation at this point? Obviously, AI is a very hot trade. Do you have more financing up ahead of you?
No question, over the next 6 months, yes, that will probably come up again. At the moment, we're really focused on continuing to iterate on the product, really giving clients the best possible experience and so on. And then when the time comes, we will get back to funding as well.
Okay. Jan Szilagyi of Reflexivity, we thank you so very much for joining us here on Bloomberg Open Interest.
Very cool.
Very interesting.
Very cool. We care.
Yes.
If you may have noticed
stuff, and we like seeing where it goes. Let's get a check on these markets, because we are looking at not only a strong day, but a really strong week. Matt, we're up about 0.25% on the S&P 500. This is going to end up as one of the best months of the year if we can keep up these gains into next week, where, of course, we have another set of big tech companies hitting the tape with earnings.
Yeah, I think the S&P 500 is now up 28% from the lows in April, so just an absolutely fascinating snapback. This week also marked the return of meme stocks, with shares of companies like Opendoor, Kohl's, GoPro, Krispy Kreme moving to extremes. Bloomberg Equities reporter Nora Melinda has looked at some investors that capitalized, maybe even kicked off this trend. She joins us now on the desk. Nora, what do you know?
Well, I've been chatting with Eric Jackson. He is a hedge fund manager out of North Toronto. He runs EMJ Capital. capital management, and he's really just been driving a lot of the rally that we've seen, specifically in Open Door Technologies. That's a digital real estate stock, and we saw that kind of being the precursor for all the stocks that came behind. We saw Kohl's shares popping, as you mentioned, Krispy Kreme, and a lot of other companies that are really popping off after we saw the surge in Open Door. But what's really interesting here is this is a long-short hedge fund, and it's a really small hedge fund. He's been pretty transparent about the fact that it's a few $1 million big. He lost a lot of his funding back in 2022 when one of his anchor investors pulled out during the tech rout. But he's really trying to recoup some of these gains. He was had a pretty strong rating on Carvana back then, and he actually got to benefit from that. And he really is having this call on Open Door. We're seeing shares that are trading, about $1 over the past couple months, but he sees the shares of the company going up to $82 here. So a pretty optimistic approach for sure, but we're definitely seeing a lot of the street, more or less retail traders rather, coming behind a lot of what he's claiming.
There are a few folks on Wall Street, but not like a massive amount of professional funds that sit there and say, I'm following the retail crowd, but he's clearly one of the people that is looking to ride this momentum.
I imagine if you're a stock trader, you have to at least look at Wall Street bets, right?
I mean, as I've been talking to other sources as well, of course, people are really skeptical about the frothiness that we're seeing in the market right now. And especially if you think about the meme stock mania that we saw back in 2021 when it had to do with GameStop and a lot of those other names. It's a different backdrop that we're dealing with right now. Back then, we had retail traders that were working with stimulus checks, and they had all this money to pour into some of these discounted names. Right now, we have a different backdrop in that rates are high. We have the geopolitical tensions. It's a very uncertain time period here, so definitely a difference nuance-wise about what we're seeing here in the meme stock rally right now versus
But we have a couple of years of 25% back-to-back gains.
Absolutely.
And they've just made so much money and everything else that they can rotate.
Right, so the question is, will we see a pullback? That's what I've been hearing from a lot of my sources on Wall Street. So lots to keep an eye on here.
Cheap hedges they recommend right now. Natalia was reporting on that a little bit too, but I think your story, worth reading it on the Bloomberg terminal. He had also talks about his tough years running the fund.
Very transparent.
Yeah.
Very cool stuff. All right, nice reporting. Nora, Melinda, you can check that out on the terminal or on Bloomberg.com. Coming up, we are 1 year away from the 2026 World Cup, which is the soccer tournament. It'll be hosted in 16 cities across the U.S., Canada, and Mexico, so all around the continent. Up next, Wall Street Week explores how Toronto is preparing to host one of the biggest sporting events in history. This is Open Interest.